Hello class, welcome to Chapter 5, Property Transactions, Capital Gains and Losses. Learning objectives for this chapter is to determine the realized gain or loss from the sale or disposition of property, determine the basis of property, distinguish between capital gains and other assets, understand how capital gains are taxed for non-corporate taxpayers, understand how capital gains are taxed for corporate taxpayers, recognize when a sale or exchange has occurred, determine the holding period for an asset when a sale or disposition occurs, describe tax planning opportunities for property transactions, describe the compliance and procedural considerations for property transactions. Taxpayer issues on property transactions. Is there realized gain or loss? Is there a recognized gain or loss? What is the character of recognized gain or loss? What is the carryover basis to assets received? What is the holding period? Property transactions generally, sale or exchange of capital assets will result in recognized gain, cap gain or loss. Then the transactions will be categorized as short-term or long-term, depending on how long the taxpayer has held the property. Short-term is going to equal held for less than 1 year. Long-term is held for greater than 1 year. Having it either short-term or long-term is going to affect on how it is taxed. So that is why it is important for the short-term. Short-term, you're going to go and use your tax basis, your tax rates. If it's long-term, it would be held for 15%. Short-term cap gains is the STCG, short-term capital loss. You have a long-term cap gains, a long-term cap gain loss. Taxpayers will combine short-term gains and losses, long-term gains losses. Net long-term capital gain or loss and net short-term cap gain or loss will be combined to derive an overall long or short term. So you just do not take the losses and gains and just put them all together. So you're gonna do the short term, and then you're gonna do the long term. Long-term cap gains are taxed at a favorable rate. The long-term cap losses are limited at $3,000 deduction per year against ordinary income. That loss can be carried forward indefinitely. The formula is the realized gain or loss equals your amount realized less your adjusted basis. The initial basis plus your capital additions minus your capital recoveries, that's going to equal your adjusted basis. So if you had an initial basis of $100,000 and you have capital additions, you bought a house for $100,000 that you want to sell and flip, capital additions of $50,000 minus any capital recoveries, which could be depreciation, that would be your adjusted basis. So off the example, it was $100,000 and you had $50,000 in capital additions, you redid the house, your new adjusted basis is going to be $150,000. Calculating realized gains or losses. So when looking at this flow chart, is the property being transferred as a gift or bequest? Yes. Then no gain or loss is realized by the recipient. No. Has an identifier event occurred to fix the gains or losses? Example, sale of exchange, condemnations, casualties, thefts, retirements? Or is it a no? So then if it's no, no gains or losses realized. If it's a yes, is the amount received greater than the property's adjusted basis? No. Taxpayer will realize a loss to the extent of the amount received exceeds the adjusted basis. Yes, the taxpayer will realize a gain to the extent amount received exceeds the adjusted basis. Realized versus recognized. Okay, so within the big circle, you have realized gain, and you have inside that circle is your recognized gain. Recognized gain, the gain or loss equals the amount actually reported on the tax return. So that's what's going to be recognized. Recognized gain is less than or equal to a realized gain. A recognized gain can never be greater than a realized gain. Reason why recognized gains don't always equal realized gains is because of non-recognition or limitation of provisions. Losses on non-trade or business property usually not deductible. Basis considerations, you're going to have costs, you're going to have gifts, you're going to have requests, conversions from personal to business use, allocation of basis. So if you had a house and it was your personal residence and you're going to convert that into either a rental or you're going to use it as a rental, then they're going to be turned into a business use, and then you would change and have to recognize your basis. Prior to that, you're not really recognizing your basis on your personal. You're not depreciating on your personal residence because of the $250,000 exclusion for you, and then a $250,000 exclusion for your spouse if you're filing married, filing joint. Cost basis calculation, that's going to be the cash plus the fair market value of the property given in exchange, plus the shipping, installation, insurance, and transit, plus the 263 UNICAP items, plus any construction loan interest. And that's going to give you your new cost basis. Identification issues. Stock is deemed sold. FIFO unless specifically identified. If mutual fund shares, owner can use specific identification, FIFO or average cost basis. Determining a donee's basis in gift property. Is the fair market value of the gifted property less than the donor's adjusted basis? No. Then did the donor pay gift tax upon transfer? No. The donee carries over donor's adjusted basis. If the fair market value of gifted property is less than the donor's basis, did the donee sell property for price? Is less than the fair market value of the gift? If yes, use the donor's adjusted basis in calculating the gain or loss. Do not add gift tax paid to the carryover basis. If it's no, use the fair market value of time of the gift in calculating the gain or loss. Do not take into account any gift tax paid. Going back to did the donor pay the gift tax upon transfer? If it's yes, then the donor's basis equals the donor's carryover basis allocated plus the gift tax paid. Allocating gift tax to basis where fair market value is greater than the donor's adjusted basis. Gift tax added to the donor's adjusted basis equals gift tax paid times the fair market value at time of the gift less the donor's adjusted basis divided by the gift and annual exclusion. 2018, the annual exclusion was $15,000 per person per donor. Property received from the decedent. Generally, a donee's basis equals fair market value at date of giver's death or alternative value date, the AVD. The exception, if the decedent died in 2010, then special rules would apply in calculating the basis. If married, decedent lived in the community property state, the surviving spouse automatically gets a step up in basis in his or her half of the property as well as the decedent's half. Converting property use to business use is the basis for business purposes. Is it equal to the lower of either the fair market value on data conversion or the owner's adjusted basis on data conversion. If the fair market value is less than the owner's basis on data conversion, then the fair market value less depreciation taken will be used to calculate the loss. Owner's adjusted basis on data conversion, less depreciation taken, and that's going to be used to calculate your gain. Allocation of a basket purchase. Step 1, determine total purchase price and the cost of outlay plus outlays for placing it in service. Step 2, determine the total fair market value of each asset purchased. You may have to obtain valuation from expert. And step 3, multiply amount from step 1 by each asset's proportionate amount of total fair market value. This will be each component's asset basis. Non-taxable stock dividends. Non-taxable stock dividends will be allocated a portion of the basis from the stock upon which the dividend was issued. A new basis per share for all shares equals the total basis. Number of shares is now owned by the taxpayer. Okay, so non-taxable stock dividends be allocated a portion of the basis. So whatever the basis was, then you're going to be allocating out for the dividend. And then your new basis is going to be your total basis, which is the number of the shares now from the taxpayer. Non-taxable stock rights equals basis. The fair market value is less than 15% of the fair market value, then the basis of rights equals 0. If the fair market rights is greater or equal to 15% of fair market value, then basis must be allocated between rights and stocks based on relative fair market value. Non-taxable stock rights equals basis. If the rights expire before used, then the basis is reallocated back to the stock. If rights are exercised, then basis of rights added to cost basis of stock. If the rights are sold, then the basis is used to determine the gain or loss. Section 1221, all property is a capital asset except inventory. 1231 assets, accounts receivables, supplies, letters, copyrights, literary, music, or artistic composition, certain hedging transactions. All property is a capital asset except self-created musical works. Taxpayer who created the property may now make an election to treat it as a sale or an exchange of capital for Section 1221B3. 1231 property. The sale of either 1221 or Section 1231 property could create capital gains or loss. If sold property is not a capital asset, then gain or loss is ordinary in nature. 1231 property includes trade or business property that is subject to depreciation. Real property used in trade or business.